What if the difference between winning and losing in investing has nothing to do with intelligence, insider tips, or secret strategies? Because here's the uncomfortable truth. Most people who lose money in the market are not lazy, and they are not stupid. They read, they watch videos, they follow trends, they try hard, and still they lose. So in this video, we are not talking about hot stocks, clever indicators, or market predictions. We are talking about behavior, the daily habits, reactions, and decisions that quietly separate winners from losers over time. In today's video, we will share the top 8 investment behaviors that separate winners and losers. These behaviors show up in stocks, crypto, forex, and long-term investing. They show up whether markets are booming or crashing. And once you see them clearly, you cannot unsee them. Let's start. 1. Winners think in probabilities. Losers think in certainty. Losers want to be right. They want confirmation. They want guarantees. Before they invest, they ask questions like, will this go up? Or is this safe? They look for someone to remove uncertainty for them. Winners think differently. They accept uncertainty from the beginning. They understand that every investment carries risk, no matter how good it looks. Instead of asking, will this work? They ask, what are the odds and what happens if I'm wrong? This shift sounds small, but it changes everything. When you think in certainty, one loss feels personal. It feels like failure. It shakes confidence. When you think about probabilities, a loss is part of the process. It is expected. It does not break your discipline. Professional investors know they can be wrong many times and still succeed. They focus on outcomes over many decisions, not one trade or one year. Losers attach emotion to individual outcomes. Winners zoom out. This behavior alone explains why many people quit just before they improve. They expected certainty in a game built on probability. 2. Winners manage risk first. Losers chase returns first. Losers enter the market thinking about profit, how much they can make, how fast they can grow money, how big the upside looks. Risk is an afterthought. Winners flip this order. They start with risk. How much can I lose if this fails? How much of my total capital am I exposing? What happens if the market moves against me for longer than expected? This behavior protects them from ruin. Risk management is not about avoiding risk. It is about sizing risk correctly. Winners understand that survival is the real edge. If you stay in the game long enough, opportunities repeat. If you blow up early, skill no longer matters. Losers often risk too much on one idea. They feel confident, so they go big. One bad streak wipes out months or years of effort. Winners risk small enough that losing streaks do not destroy them. This is why you will often see calm investors outperform aggressive ones over time. Calm comes from knowing a single mistake cannot end everything. 3. Winners separate emotion from execution. Losers trade their feelings. Markets trigger emotion by design. Fast moves create excitement. Sharp drops create fear. News amplifies both. Losers react in real time. They buy because prices rise. They sell because prices fall. Their decisions follow emotion, not structure. Winners expect emotional pressure. They plan before it shows up. They define rules in advance. When to buy, when to add, when to reduce risk, when to exit. These rules act like guardrails. They limit damage when emotions spike. This does not mean winners feel nothing. They feel fear and greed like everyone else. The difference is they do not let those feelings control action. Losers confuse action with control. Winners understand that sometimes doing nothing is the most disciplined move. If your mood changes with every price move, behavior is already working against you. 4. Winners respect time. Losers fight it. Time is one of the most misunderstood forces in investing. Losers want speed. They want fast results. They feel impatient when progress looks slow. They jump between strategies, assets, and ideas because they feel behind. Winners respect time as an advantage. They understand that compounding needs consistency, not excitement. They match their investments to their timelines. Short-term money stays stable. Long-term money accepts volatility. This behavior reduces stress. It also improves results. When you fight time, every dip feels urgent. Every delay feels like failure. When you respect time, volatility becomes tolerable. You stop forcing outcomes. This is why systematic investing works so well for long-term goals. It removes timing pressure. It allows discipline to do the heavy lifting. Losers keep searching for shortcuts. Winners let time work quietly in their favor. 5. Winners follow process. Losers chase outcomes. Losers judge decisions by immediate results. If something makes money, it must have been smart. If it loses money, it must have been wrong. Winners judge decisions by process. They ask, did I follow my rules? Not did I win? Because they know good processes can lose sometimes, and bad processes can win temporarily. This mindset protects them from false confidence and unnecessary regret. Outcome-focused behavior creates emotional whiplash. One win builds overconfidence. One loss creates doubt. Process-focused behavior creates stability. Winners improve their process slowly. They review decisions calmly. They adjust based on data, not emotion. Losers abandon strategies too early. They jump to the next idea after a loss, never giving any edge time to work. This is one of the hardest behaviors to adopt because humans are wired to react to results. But investing rewards those who can delay emotional judgment. 6. Winners understand position sizing. Losers bet too big. Many investors talk about strategy. Few talk about size. Losers often take positions that are too large relative to their capital. They feel confident, so they concentrate heavily. When the market moves against them, stress explodes. Winners size positions deliberately. They know that even the best idea can fail. Position sizing ensures that no single decision dominates a portfolio. This keeps emotions manageable and decisions rational. This behavior also allows consistency. When risk per decision is controlled, winners can repeat their process many times. Repetition is where probability plays out. Losers often have fewer chances because each mistake costs too much. Winners give themselves room to be wrong and still continue. This is why many professionals risk small percentages per position. It is not about fear. It is about longevity. 7. Winners accept being wrong. Losers fight it. Losers hate being wrong. They defend bad decisions. They hold losing positions hoping to break even. They avoid admitting mistakes because it hurts their ego. Winners accept being wrong quickly. They see losses as information. If the reason for a trade or investment no longer holds, they exit without drama. Ego does not get involved. This behavior protects capital and mental energy. Holding on to bad ideas wastes both. It creates stress and prevents focus on better opportunities. Winners know that being wrong is part of the job. The goal is not to avoid mistakes. The goal is to limit damage when they happen. This mindset shift alone separates many long-term winners from chronic losers. 8. Winners stay disciplined during boring periods. Losers only act during excitement. Most investing is boring. Long stretches of sideways movement. Slow progress. Few headlines. Losers lose interest during these periods. They stop following their plan. They seek excitement. They overtrade. Winners stay disciplined even when nothing feels exciting. They keep investing. They rebalance. They review calmly. They understand that boredom often comes before big opportunities. Excitement feels productive, but often leads to mistakes. Boredom feels unproductive, but it builds consistency. This behavior explains why many people enter markets at the worst times. They show up when excitement is highest. Winners are already positioned before the crowd arrives. Now let's connect all 8 behaviors. Winners think in probabilities, not certainty. They manage risk before returns. They control emotions with structure. They respect time. They follow a process. They size positions wisely. They accept being wrong. They stay disciplined when things feel boring. Losers do the opposite, often without realizing it. The key insight is this. Investing success is behavioral before it is technical. Charts, indicators, and data matter. But behavior decides whether those tools help or harm you. You do not need to become perfect overnight. You only need to improve one behavior at a time. Start by asking yourself honest questions. Do I react emotionally? Do I risk too much? Do I judge myself by short-term results? Do I follow a process? Awareness is the first upgrade. Let's wrap this up. Winning investors are not special. They are disciplined. They protect capital. They accept uncertainty. They act consistently when others react emotionally. Over time, these behaviors compound just like money does, quietly and powerfully. The real edge is not predicting markets, but avoiding repeated mistakes that drain results. If this video helped you see investing more clearly, like it, share it with someone who struggles with emotional decisions, and subscribe to the channel for more simple, practical investing content. Thanks for watching.